because on that 250 or 500, we don't want to have to prorate that depending on what your future gain is. So effectively, a business asset you have to pay gains on. Your personal residence, you don't have to pay gains. And I don't want to take a deduction for a couple dollars this year and lose on a gain 3 years from now. So it would be something worth examining a little closer, Diana, whatever your longer term plan is. We can always maybe talk it through a little more detail if you want to set up a time more focused, but you can depreciate that. But being the personal residence, I wouldn't want to jam you up in the future and run into any issue with that. So hope that covers that. Another question, pros and cons, created LLC every time for flipping and then sold this LLC. When I sold a property, this LLC would dissolve. So it sounds like right now, Mike is setting up an LLC every time he does a property to flip. And then I'm assuming maybe it's a single member LLC. If it's a partnership LLC, it won't automatically dissolve. If it's a single member, it's what's called a disregarded entity. And it's for those of you new investors, if you're setting up an LLC on your own, you can set up an LLC, and if it has one partner, it's disregarded for tax purposes. You have legal protection, assuming you're doing everything, but it's disregarded. That's why I think back to Emmett's question, the tax rates are effectively the same on a single member LLC, but then if it's a partnership LLC, Mike and I would have to have a partnership return. So that's something to consider. But if it's a single member, once he sells that property, he'll have a transaction on his tax return. And then if he just stops updating it with the state of Michigan, they will automatically dissolve it. I would say generally dissolve that LLC, file the paperwork. I believe it's $20 or $25 to dissolve that. But if you're flipping, once you have a set up LLC and you sell property A and and it's inactive now, you might want to use that again for property E down the road, your next property. And so that because you should have a separate bank account to be able to manage that deal. But I would generally advise, if you're setting these LLCs up, I might reuse them if once you've sold the property, if you're trying to keep them separate while you have deals going. Once you've sold the deal, you might want to recycle those LLCs versus setting up new ones. But hope that covers that aspect. And then really on the flips, and I hear that brought up, not sure when everyone's using the term flip. Are you buying a property to improve it and then sell it on the retail market? Or are you buying it to improve for a rental and either sell as a turnkey? That would be another reason to segregate those activities into separate LLCs, because LLC A has property in, let's say, Detroit, and right now is a rental. I put a unit in there that might be an investment, while LLC B has property that's going to be a flip, and I can start to separate those back to the self-employment issue. Definitely something to really tune up a little bit closer. Right now, I think we have about 20 people on this, and I'd say there's probably 19 different strategies that would impact everybody a little bit different, depending on how you're doing it with a partner, if you're married, not married, if you have kids, age, everybody's at different places. So always really focus on what works for you. A lot of this is general, but then, okay. So it sounds like three different LLCs, two companies for flipping and one strictly for rentals. Sounds like really a perfect scenario. The flipping activities are going, and then the rentals. One note, I with the rentals, they're in an LLC. I would say rentals never put in an S corporation or an LLC taxed as an S corporation because I don't know if Mike has debt on that property or not. If he's bought it for X, improved those rentals, put a tenant in there, and done what's called a cash out refi. A lot of you, I'm sure, are familiar with the term or have heard it used different ways. But let's say I buy a property for 50,000. I improve it a little. I put a tenant in it. It appraises for 100. I go to the bank and get a mortgage for 80,000 and walk away with my initial 50 plus 20 or 30. I'm going to end up being negative 30 into that property. With an LLC, that's what's called effectively a tax-free event because the debt will provide basis. An S corporation, when I take that extra 30,000, that's what's called a distribution in excess of basis. And an S corporation would actually be a taxable event when I take that money out of the business bank account and put it into my personal bank account. So I always bring that up because I get the question, S corp versus LLC. It really depends what you're doing. And then bought one on LLC and transfer one. Okay, so, but I believe they're all still maintained in an LLC, either as a disregarded entity or a partnership. So that by the fact of refinancing that, that's not triggering a taxable event. And effectively, if you hold those rental properties until the day you die and keep refinancing them as you appreciate, that's where we really get into this tax savings and wealth building strategies. You can hold those properties till the day you die and not pay any tax on that transaction, because if you keep refinancing that, you end up with what's called negative basis. And then when you die, your heirs will inherit that property, maybe fully leveraged, but they'll effectively sell it and pay no tax on that, even though you may have held it for 20 years, taken out $100,000 tax free. So it's something to really consider. Right now, I've seen some proposals. They're looking at maybe potentially doing away with that. Not entirely sure how that's all going to pan out, but as you start to refinance properties, it's something to definitely be aware of, because when you start refinancing and leveraging properties, you could end up, in my previous example, purchase a property for 50, it appraises for 100, I sell it for, or refinance it for 80, I sell it 2 years later, ignoring depreciation, I'm going to have a $50,000 gain. But after I pay off the debt, I'm going to only walk away with $20,000. So that's where you would start to want to look at using a 1031 and different strategies. Everything in this presentation is really based on current tax law today on November 10th, 2020. Not sure what's going to change in the future, but we can always go from there. So looks like a few people joined us. Welcome, everybody. Feel free in the chat box if you have any questions, chime in or type questions. We're just right now taking questions, kind of an informal, not necessarily presentation. I'm kind of looking at the agenda. I think we're covering a lot, but if anybody has any questions, keep them coming.
Yeah, this is Mark. Could whoever's got their TV on, can you mute yourself so we can hear better? Thank you.
The new normal now. Okay, but if does anyone else, or I see someone coming in. Anybody have any questions? And feel free to unmute yourself and chime in if you have any questions, or in the chat box that we
Frank,
have.
we've got a ton of brand new investors, so maybe you could just spend a second. Why would I even want a limited liability company?
Okay.
What does
Okay.
that do for me?
Okay. Yeah. Definitely. Mark, keep the questions directed, and we can get high level. But so really, as a new investor starting out your business, having a limited liability company, again, discuss it with your attorney and your professional advisors, what's going to make sense. But I get that question a lot. I say anybody that's really taken the time to be on something like this is, if you're new, you're taking the first step, but really running your business like a business, you're going to generally be more successful. But if you have a business entity, what you're going to really do is you're going to need a business bank account, a separate books and records. And I have clients that work with QuickBooks. There's other rental systems out there. There's other systems able to work with someone on a different variety. I have some clients that track their expenses through Excel, but as you have different LLCs or different companies, you can really start to define what your business is. I think that we have some people flipping, some more buy and hold investors. We have people really doing a little bit of both through different entities. So as a new investor, I think we have most people here are in Michigan, but I think some are from out of state. Definitely look at your particular state. I know within the state of Michigan, setting up an LLC and maintaining it at the state level is generally cheap. One thing to keep note, when you do own rental properties, certain localities, if I own a property in my personal name, when it comes down to eviction, in certain areas, I'm able to represent myself. Other ones, if it's owned by an LLC, I have to hire an attorney. Other times, if you're going to refinance the property, some commercial or traditional mortgage companies generally do not loan to LLCs. So you might have to transfer a property back and forth, but if you can start to account for your business and really treat it as a business. So I think having an LLC is not bad, but don't go and set up bunch of LLCs and an S corp structure. I've had people come to me with this whole corporate structure, never even done a deal yet. So usually having an idea, or at least the people that can do it for you, because an LLC can really be fast tracked and be set up in a day or two. So knowing when you pull the trigger, if you have a deal you're closing on this Friday, today's Tuesday, you could have an LLC, an ID number, and a bank account set up by then. But just knowing how to have it done. Right now, as we approach the end of the year, it may not make sense if someone's just starting out until doing it right into the new year, because I would hate for someone to set up an S corporation or a partnership LLC and have additional tax filings for no activity. If someone's knows they're going to get started in January, started on January 2nd, not December 28th, because that's 1 year of tax returns that have to be done unnecessarily. So I would generally advise someone to start it in January. Did that answer your question, Mark?
Yes.
Okay.
Yeah. And then it also provides them some liability protection personally, correct?
Yes.
Yeah.
So assuming that they're doing everything, let's say I own assets and other rentals, and I have a rental property that's Frank Property One LLC, and Mark's my tenant, and he sues me for something that generally between the LLC protection, assuming I'm doing everything correctly, and my insurance, it would generally insulate Mark from suing me and obtaining my other assets, and give me that other protection there. Again, not an attorney, so this isn't legal advice. It's more general advice, something to discuss, but it will give you that different protection. And then again, I like it because it helps you identify what you're doing. You have your investment LLC, your flipping LLC, your buy and hold. So, so I think that's good. I have another question came in. Client who's selling his property in the past 5 years. He lived in it for 2 years and the rest 3 years as a rental. What's his tax consequence at his sale? Can he reap the capital gain if it falls below 250? So depending on if he depreciated that, someone else asked a question earlier about a duplex. I forget who that was, but this would be a similar situation. So I'm assuming that this person bought a property 5 years ago, lived in it for 2 years, then rented the property for 3 years, and then is selling it now. And let's assume that they're only making 100,000 below the 250, I think is the question. Can they exclude that? So during the 3 years, I would assume they probably took some depreciation on that. Generally, they're going to be able to exclude part of that gain, but there may be some depreciation recapture, because if the 3 years they rented the property, and let's just guess that they took $15,000 in depreciation, they're going to have to recapture that because they had a benefit on that depreciation. Can't really speak to all the details without seeing the info, but it's something to definitely look at. It would really depend how it was treated, but that's where earlier we had a question on a duplex and the person was living in the other unit. And that's where really being cognizant of what your future plans are with that property. So most of that gain, I would guess, would be excludable, but without seeing the numbers. But yes, a prorated amount of that 250, they still should qualify because they did live in it for 2 of the last 5 years. Hope that answers your question, Kevin. Another question here that came in: wholesaled a few homes, asked the title company for 1099 info in order to file, or should something be sent after after he's closed on the deals? So generally, I work with a lot of wholesalers also. The title company, when they pay, let's say I wholesale a house and Mark buys the house from the other party, and I'm just getting what's called my assignment fee. For those of you that aren't familiar with it, not for those of you that aren't familiar with wholesaling, Frank, go out, I connect with a seller that has a property. It might be in bad condition or different situation, and then I get it under contract. In the meantime, I'm going to go connect with Mark as a real estate investor and sell him the house effectively. And Mark's going to end up coming to the closing table. Sometimes there's a dual close where I borrow the money, and let's say I'm buying a house from Ruth. I see your picture there. I'm buying Ruth's house. She wants to sell it, and I connect her with Mark. I might buy the house from Mark or Ruth, sell it to Mark. In that situation, it was actually a dual transaction where I bought a house and sold it. Assuming what Emmett's referring to is more of a transaction fee, that I get the house under contract with Ruth. Mark is coming to the closing table, and I'm getting an assignment fee from at closing, and I'm walking out with just one closing transaction being done, and I'm getting a check that I'm walking out with from the title company. Most title companies don't issue 1099s, so I'm going to get that money. And really, the only evidence of that, they don't need. Ruth won't have to, or Mark won't have to give me a 1099 because he never paid me. The title company generally isn't going to give me a 1099 for that fee. But again, it goes back to treating your business as a business. Once I get that check for my assignment fee, I go to my business account, I deposit it, and then that's going to be income within my business. A lot of times I've had people, well, if I didn't get a 1099, I don't have to report it. First off, any income you receive has to be reported according to the IRS. And if you actually ever get audited, they're going to pull every one of your bank accounts, and every deposit they assume is income until you tell them otherwise. So that's where keeping a clean trail of everything does help. But if I'm putting it into my business account because I set myself up as an LLC and I'm tracking it, I'm going to have income. But in the meantime, treating my business as a business, there's a lot of expenses. I might have costs that I marketed to Ruth to connect with her to find out that she has a deal. I have costs maybe for my cell phone, maybe for my mileage to go visit her. So these are all the expenses that income you're getting from the title company can probably be chipped away, and you still need to really report it. I'm not saying don't report it, but there's ways to really capture your expenses. And once I get the check from the title company, if they make it out to Frank, I'd rather put it in my business account because now it's going to evidence that I have a business. So the expenses I took last year when I was starting my business to grow my wholesaling business can all be justified because I'm getting wholesale money that I'm spending on any marketing. You really have to be able to justify it. So you get into the hobby loss rules. But the fact that they're not giving you a 1099, generally title, I wouldn't expect that the title company is going to give you the 1099, just really keeping a track of your books and records. And then that's where my point about the IRS and an audit, I've had clients that refinance properties and big lump sum monies are coming into accounts, and the IRS has taken the position that that 50,000 was income, and then when they sold it, that other amount was income. That's why being able to account for it, that 50,000, I can show a closing statement right here that shows those are proceeds from the bank and it's not taxable income. You can justify everything, and that's what the IRS is generally looking for. So Mark asked earlier about setting up an LLC. Really, those disciplines in the beginning, treating your business like a business, you start to develop those. I would say if I'm flipping houses and I get some wholesale fees, I might put all that activity in the same bank account and really treat it as all the same line of business. I might not put my wholesale fees in my rental business. I would try to keep those separate, would be how I would do it. Hope that helps. But if someone's looking for a 1099, I don't know that they would send it. But usually if you're reporting it on your taxes down the road for any requirements of future financing or anything, a lender would see it on your tax return and your bank statements. So that would be proof enough that you made that money and it was income. Okay. Any other questions from anybody? Maureen or Mark, anything?
Yeah, some people probably don't want to ask what they'd really like to talk about, or they actually have a tax problem. So if they had that and they wanted to talk to you, how do you do that?
Oh, talk as far as talk to me.
Yeah, do you do a consultation or how?
Yes. If you go to cpanerd.com, I've got an online scheduler. Um, the times are kind of tight there, but I can also be reached at frank@cpanerd.com. And someone can connect with me. I can set something up. If you send me an email, say that we connected on here. I think I do them between 4 and 5 in the afternoon, but a lot of people, I would say, if that time doesn't work, maybe connect with me if we've connected on here, and we can try to work something out as far as a different time. Sometimes there's some time zone differences and stuff. I work with clients from all the way to the Ukraine to South America, and I've had meetings at 4 a.m. my time. So flexible, but I would check cpanerd.com, and I'll put that in the chat here, and everyone can find that. And then at the top, there's a 20-minute session. It'll take you to a scheduler and go from there. And then I'll put a direct link to so one's the CPA Nerd, then the other is just the sign up form for the time. So that's the best way to contact me. And then one question as far as a CPA, an attorney, I think in Albuquerque. I don't know of anybody specifically down there. I work with clients in all the various states. Could even set up a time we could discuss it further. I have a couple real estate attorneys that are here in Michigan. Depending on what the need is, if it's structural, if it's something specifically, I think in Albuquerque, from a tenant standpoint, I'd advise probably a local attorney, definitely. From a tax standpoint, I'd like to say that I'd be able to help. I work with a lot of clients in many different states, but I also am part of some groups. I could find somebody local if it's something that was of interest, but can always connect with you and kind of discuss further.
Yeah, earlier people brought up doing partnerships.
Okay.
I'm going to just advise against that as much as possible, because you get into a property and then somebody feels like they're doing more work than the other person, and it leads to conflicts, and it's just a really tough situation. The only partnerships after learning it the hard way, that I attempt to go into today is a planned divorce. And by that, I mean, it's myself and maybe another wholesaler, and we're just putting a house under contract, but we only have one thing in mind, and that's to liquidate the property so we can both go our separate ways. So you want to really think twice before you do partnership. And if you do, just you're going to have a lot of more questions answered. So that makes it for a tougher situation. Just wanted to put my 2 cents in.